Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, we've been talking about the Social Security system, and on today's show, the impact of tax advantage products on Social Security benefits. And with me today is Ken Davis, COU, CHFC, CFP, and CPA. Hi, everyone. I'm Steve Savine, syndicated financial columnist and contributing author of Backroom Technician. Let's get down to business. Well, here we are on the last day, 5 straight days of Social Security mania. And now we're talking about some of the solutions. You started dipping your toe into combination annuities, the old split annuity scenario, which we used to do all the time until interest rates went down the tubes. Ken, we're talking about, we touched on this, I want to just touch on before we get into our life insurance, Roth IRA. Both of them have really great tax advantages. I have seen times where I really need to do the Roth IRA. The life insurance isn't the way to go.
Right.
It just isn't the way. There's a lot of reasons for it. But I'm starting to let our advisors know, look at both of them. There could be a reason to look at one over the other. And we always have that yin and yang. And give me a good reason why I would use life insurance, because everybody pretty much knows the Roth story.
Well, it's all down to what is the goal of the client. What is the client end game? What result are they trying to achieve? Life insurance has attributes a Roth doesn't have, and a Roth has attributes life insurance doesn't. For instance, I don't have to wait till 59 and a half to pull cash out of a life insurance policy.
You can go get it. That's right.
I don't have to wait 5 years for it to be in a Roth before I can take it out and not be taxed on it. Okay, so in some ways it's more liquid, especially when you plan earlier in ages as opposed to later. The other thing is, let's think about what the end game. When somebody passes away, yes, I can, if I designate a beneficiary and I do my planning properly, I can do a stretch IRA kind of concept with a Roth and pass it on to generations. But what happens? They are now, if it's not a spouse, they are now required to take certain distributions over a period of time, right? Okay, so I don't have as much control. Whereas if I get a lump sum from a life insurance policy, it's all tax-free, and they can do anything they want with it. They can then go out and fund maybe a 5-pay life insurance and just continue the same strategy. They can take it out at will when they want it. And then at death, that comes out and the next generation gets to do it. So generation after generation gets to do it, and guess what? Life insurance pays more than the cash value, especially if it's in the earlier years. So the heirs have more money potentially than they have in the Roth. It's just simple of what are they trying to achieve? Is maximizing benefits to the next generation a priority? Is life insurance appropriate in that particular situation, or are they just clean it all up and just go straight to a Roth IRA and have, whatever investments they want to play with? So it's a matter of what are they trying to achieve, then looking at the attributes of the two strategies, either by themselves or in combination, and which one gets the client to the goal that they want to have, and look at tax issues, liquidity, other types of stuff.
Well, we're talking about, because it's kind of a new introduction to some advisors, a lot of our population. They say, well, I really never tried life insurance. So we're not just talking about any cash value life insurance. We're talking about TAMRA compliant, non-modified endowment, has to be kept in force for the life of the insured. But let's say we're all there on that, and we'll do a whole show on that just so people understand it. But the tax benefits are huge. And especially if I know I'm going to be passing on whatever I don't use to the next generation, the life insurance transfer is probably the way to go. But there's real good reasons that we use Roth IRAs, and we're still talking about it because we want to make sure all our people know that we're going to look at both scenarios and figure out which one is the better way to go. We're trying to give our Social Security benefits a chance. We're trying to give the benefits to be the least taxation. We're trying not to have to worry about Medicare. I might have to do that too. Obamacare. There's other issues we talked about yesterday. Let's talk about more on this annuity, because I heard you say this. I love the way you were saying. You say, you're doing these things. You're layering. It sounds like this laddering approach to annuities that give this kind of deferral aspect with an end product of maybe a TAMRA compliant life insurance contract at the end. That sounds like you like that as a CPA because you enjoy a lot of the tax benefits, not only of deferral, but this long game of different time periods.
I like choice. Choice allows me to make decisions. One thing I can guarantee our viewers, one thing I can guarantee is the tax laws are going to change. They change daily. They are going to be different 5 and 10 and 20 and 30 years out than they are today. And the state taxes will be different. We don't know what it's going to look like. So if I had all my eggs in one basket, it's kind of like we do with investments. We don't put all our eggs in one basket. We separate it out, and it gives us choice. It helps reduce against risk. Well, by layering in different tax strategies, it helps protect against change in tax law risk. Okay? So what that means is I can look at my different elements. I could have a Roth IRA. I could have a life insurance policy. I could have an annuity. I could have CDs. I could have all these different assets to pick from, capital gains treatment. And whatever it is, 20 years out, I can say, gee, this is really cool. I layered all these strategies in. Yes, they've changed the rules of the game on me, but I have choice now. This isn't as good as it started out to be. This one's better. In relation to that, this one's better, so I get to pick what gives me the best tax result. What's interesting is, one of the projection software packages I use makes a big deal out of the order that you pull money out of different assets. And it's amazing the wealth that's created just by changing the order of different types of assets. I had a client who was making major contributions to a charity. He was a great guy. He was taking money out of his IRA to pay that. He's paying full ordinary income tax rates. He had a bunch of assets that had capital gain that were liquid. He took the money out of that, instead had tax basis, reduced his taxes. He calls me after tax season and says, oh my God, boy, did you save me. And I said, what do you mean? He says, well, I paid $15,000 less in taxes because I let my IRA grow and I took the income from the other source. And then ultimately he showed me that when you leave the IRA to charity, it's not going to be taxed at all. So this is fabulous for income tax and for estate taxes.
Honestly, Ken, we should do a show on distribution at retirement. Not only addressing Social Security, Medicare, and Obamacare, things we're talking about now, but what comes out first. It's not only tax diversity, it's when it's taken out on distribution. When we come back from the break, we're going to continue our conversation on tax advantage products, including TAMRA compliant, non-MEC cash value life insurance. And don't forget, you can request all our show's documents that we use as sample examples from Backroom Technician at ashbrokerage.com, or if you want, just sign up for your own 30-day free trial at Backroom Technician, www.brtnow.com/trialsignup.aspx. We'll be right back, right after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life, from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back. I'm Steve Savant with Ken Davis. And remember, you can watch all the episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, at www.ashbrokerage.com. And just click on the show when you come out to the logo on the homepage, and I'll take you right out to the show. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, as well as your broker-dealer compliance officer. Let's get down to business. We're talking about trying to keep more money in retirement. This whole week we've been saying it's the Social Security system, but we're just trying to keep more money at retirement, whether it's Social Security, Medicare, or Obamacare now, and Ken starts throwing in AMT yesterday, and now we're talking about trying to do diversification in taxation, different product durations in retirement, and he flirted with an idea. I can't talk about it today, but now that you brought it up, next time we have Ken in, we're going to do a whole show on distributions, because you said there are major tactical issues on distribution that could be huge. We'll save that for another day. Okay, Ken, let's talk about this now. We talked about layering these annuities, maybe having I love the idea of you're doing a single premium annuity at the front end. There's not going to be hardly any gain to that, so that's all going to be coming into me, right? It's mostly almost all return to principal. Then I've deferred another maybe 5 or 10 years on the annuity. Maybe I used indexing as an example, and I hold on that position. And now I'm also in life insurance on the really long haul monies, getting out of the surrender period. I want to get out of that. I want to reduce my cost of insurance. I'm trying to give the best possible return depending upon whatever credit methodology I use. Talk to me about why this is so important to think in terms of different tax times, different durations of product. Why does it matter?
Well, this too gets a little sophisticated at times. The simple concept is I take 100,000, 50,000, 200,000, whatever, and I break it into pieces. And I might buy an immediate annuity that pays me for 5 years. Well, the tax results of that is that each of those payments, I get to take my total investment, divide it by 5, because it's 5 years in duration, and that portion, so if I put in $100 grand, $20,000 a year is tax-free. So if I get $20,500 each year, only the $500 is included in gross income and flows to adjusted gross income. So instead of having to pay interest, getting interest income and including it in AGI, I essentially get a cash flow, but most of it's considered my own money.
You're buying some time here.
Right. The remainder goes into a deferred or growth account that builds tax deferred. There are no 1099s coming off a deferred annuity at the end of the year. So what I do is I have a 5-year immediate annuity, then maybe a couple of 5-year deferred annuities, and then maybe an indexed annuity with a lifetime income benefit rider, and I'll get into that in a second. So we turn on the income for the first one with the immediate. One of these 2 deferred annuities, we turn the switch on and we annuitize that for 5 years. And then we do this for the third tranche, and so we've got 15 years of guaranteed income, okay? It depends upon the annuity we purchase, but we can make it guaranteed or we can make it flexible. And then the final part of it is, 65-year-old person's now 80 years old, 15 years into it. They now have the lifetime income benefit rider on an indexed annuity. If the indexing strategy did just really well, they can use that money. It's real cash. If they don't have the real cash to have grown back, and the lifetime income benefit rider had a 6, 7, 8% growth factor, now they can take this income base, not a cash base, but income base, and they can turn on a lifetime income off this. And slowly but surely the cash eats away at the cash account and eventually may get to zero, but they still get the income. So the beauty of this is that we're controlling taxes, we're turning on different valves at different times, and we're providing essentially a minimum guaranteed income to these folks. And that's what retirees want. They're less concerned about cash balances and interest rates than they are the cash flow that can't be outlived. And finally, instead of the lifetime income benefit rider, if they're willing to take a little bit of risk, we normally don't sell life insurance policies for cash accumulated at 65. It doesn't work.
Right.
Why it doesn't work is because it takes about 15 years for this to mature. Well, if I do those 3 annuities, the immediate 2 5-year deferreds, and then have the life insurance at the end, now it matures. Now he's 80 years old. He might have died and there's this windfall to his kids, right? Which he might like. That might be one of his goals. Or if he's still living, he or she, we start turning on withdrawals of tax basis, tax-free, and then loans to gain, or we might just borrow against the contract depending upon how the numbers flow. So we have all these strategies where we can combine this, and I know that's a whole lot of information, but we're just trying to introduce our viewers to the possibility that we can control this, and they can start to research into it, work with their IMOs to get this done and do these strategies.
Well, I'm thinking about the combination of different types of annuities at different times with life insurance. I'm using different tax tactics. I'm using different crediting methods. I'm using different types. And all these combinations, these laddering effects, have impact on the way we pay taxes and how everything hits the adjusted gross income.
Well, and one of the reasons I started throwing the life insurance on the tail end is one of the downfalls of the combination annuity or split annuity is it works great. I have a lot of tax basis on the first annuity. The second one, I've got tax basis, but now all these earnings are deferred. That means my ratio of the portion that's tax-free is getting smaller and smaller as time goes by. And then of course at death, annuities are terrible because all deferred taxes come due. Well, if I can live off this first layering, life insurance comes out tax-free at death, and I can take tax-free income. It doesn't matter what my tax basis is on that point.
I love that, and that is a huge point, and I love to see, we're going to have to do a workshop on that, put the graphic up on the display on our Mondo pad, and show everybody why the mechanics of this is so powerful for your client. Well, that's our show for the whole week. I want to remind you that you can read all my online insurance commentary, advisor blogs, and articles at Producers Web, and my answers to consumer questions on Insurance Library. And remember, you can view all our shows on our on-demand section located at Ash Brokerage. So don't forget to follow me on Twitter, Facebook, and LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. Have a great weekend, everyone.